Only 38% of vault silver is real. Leak is either a misread statistic, or it is the cleanest warning yet that paper silver is running ahead of what can actually be delivered, and the market is already trading like it knows the difference. Because if the crowd thinks this is about fake bars, they'll miss the real mechanism. And the real mechanism is simpler, colder, and more dangerous. Deliverability, not existence. Deliverability. And once a market starts pricing deliverability, the screen price becomes the least honest number in the room. Stay with me, because by the end I'll have a practical checklist for what to watch over the next week or two, what level matters, what would break this story, and why the calendar is the catalyst that can turn a normal pullback into a gap you don't even get a second chance to trade. Now, let's slow down just enough to not get hypnotized by the headline. The phrase, only 38% is real, is designed to trigger one image in your mind, an empty vault and a giant fraud. It's cinematic. It's viral. It's also, in most cases, not how these systems fail. The market doesn't need fake metal to create a very real squeeze. It only needs metal that exists, but isn't available to you on the terms you assumed. And that's where the real pressure starts. Here's what's actually happening in silver right now, and why this leak, real, distorted, or weaponized, lands on dry tinder. Silver has been ripping and snapping in a way that screams stress, not calm discovery. We've seen it whip from the low 70s per ounce to above $80 in a matter of sessions this month, with intraday ranges that look more like a crowded theater with one exit than a sleepy commodity market. That kind of move isn't just bullish, it's unstable. It's a market where positioning is leaning, liquidity is thinning, and the marginal buyer is being forced to pay up at the worst moments. And that's before you even talk about a vault. But that's not the part that matters. The part that matters is how the market behaves when everyone's staring at the wrong symbol. When a market is truly comfortable, you don't see nervous behaviors pop up in multiple places at the same time. You don't see physical premiums acting weird. You don't see delivery chatter rising. You don't see spreads behaving like someone is paying extra for now over later. And you don't see price whipping around like it's trying to shake you out and pull you back in on the same day. Those things don't happen because the internet found a scary number. They happen because the plumbing is under strain and the participants closest to the plumbing can feel it. But the crowd never looks there first. They look at the headline. So let's strip the headline down to what it could realistically mean. There are a few possibilities. 1, it's simply false or exaggerated beyond recognition. 2, that's technically true inside a very specific definition, like only 38% is in the category that can be delivered against futures right now. And someone converted that into only 38% is real, because outrage travels faster than nuance. 3, it's a deliberate framing meant to push retail into emotional decisions. Panic buying, panic selling, or the worst of all worlds, leverage at the top. You don't need to pick a conspiracy to protect yourself. You just need to understand incentives. The incentive is simple. When volatility is high, attention is money, and fear is the fastest attention. But here's the hidden detail that reframes the entire story, and once you see it, you can't unsee it. In the biggest warehouse systems tied to futures delivery, metal is often categorized in a way that confuses people on purpose. There is metal that is registered for delivery, meaning it's been put in the deliverable lane, tagged and ready to meet the contract specs. And there is a metal that is eligible, meaning it meets the specs and it is real and stored in the system, but it is not registered for delivery because it belongs to someone who hasn't committed it to that deliverable lane. It acts like a parking lot with 2 zones. One zone is the valet lane where keys are on the hook, and the other zone is a private garage where cars are real, but the owners haven't agreed to hand you the keys just because you showed up with a receipt. If someone says only 38% is real, when they actually looking at only 38% is registered, the bars didn't evaporate. The bars didn't turn fake. The bars just aren't volunteered into the delivery pipeline. And if you're trading paper as if every ounce in the building is instantly deliverable, you're trading a story, not a structure, and that's the detail that flips the whole setup. Because a market can go from fine to violent, not when metal disappears, but when fewer owners are willing to make their metal available at the posted paper price. That's not fraud. That's supply choosing a price. And when supply chooses a price, paper has to chase. Now, how does that chase actually happen? This is where people drift into vague talk about manipulation, and it's usually sloppy. Let's keep it tight and finance real. Futures markets are a structure. They're not evil, they're a machine. The machine works until enough participants demand physical delivery or immediate exposure at the same time, and the machine has to reconcile paper claims with physical logistics, category constraints, and risk management. If you're short a futures contract, you can close it by buying it back. If you hold it into delivery, you either deliver the metal or you roll or you settle through the rules of the system. In normal times, most people roll. In stress times, more people push toward delivery or toward near-term tightness. And the spreads start telling you the truth before the headlines do. And that's not a metaphor. Spreads are literally the price of time. When the nearby contract trades rich to the deferred, when backwardation shows up or deepens, it's the market paying a premium for immediacy. It's the market saying, I don't want a promise next month. I want the thing now. And if enough of that builds, it forces behavior. Dealers hedge differently. Shorts get nervous. Inventory managers make calls. And that's where the squeeze starts, not in a tweet. But it gets worse because the market doesn't just move on tightness. It moves on positioning under tightness. And right now, silver has all the ingredients for reflexive moves. Big volatility, thin liquidity windows, headline-driven crowds, and structural constraints that can make near-term supply feel smaller than it looks on paper. So let's talk mechanics. Plain English, no fog. There are two classic engines that turn stress into a spike, short covering under margin pressure and dealer hedging under options exposure. You only need one for a brutal move. Sometimes you get both. Start with short covering. When silver rips higher fast, anyone short futures starts bleeding mark-to-market immediately. Their broker doesn't care about their long-term thesis. Their broker cares about margin today. If the move is sharp enough, the short has to post more collateral or reduce exposure. If they can't or won't post, they cover, meaning they buy back contracts into a rising market. The buying is not bullish sentiment. It's forced demand. Forced demand is the most explosive kind because it ignores price. And once forced buying begins, it tends to cascade because each uptick pressures the next weak short. That's why squeezes look like stairs that suddenly become an elevator. But that's not the only engine. Options can do it too. When a lot of call options sit at certain strikes and price approaches those strikes, dealers who sold those calls hedge by buying the underlying as price rises, especially if gamma is high. That can create a feedback loop. Price up forces hedging buys, which pushes price up, which forces more hedging buys. It's not magic, it's hedging math. And when liquidity is thin, that math is louder. But here's the key. Whether the engine is shorts, options, or both, it becomes far more dangerous when the physical side is not freely offering supply at the screen price. Because then you don't just have paper chasing paper, you have paper chasing a constraint, and constraints don't negotiate. Now, let's anchor this to reality without pretending we have secret warehouse access. The way you know a market is stressed is not one data point, it's a stack. Mechanism, then symptom, then confirmation across different surfaces. So here's the proof stack you should care about, and it's designed to work even if you never trust a headline again. First, term structure. Watch the relationship between nearby and deferred pricing. If the nearby is persistently rich, if backwardation appears or deepens, that's the market paying up for immediacy. That's a deliverability signal. Second, inventory categories, not just totals. A big total number can hide the fact that the deliverable category is shrinking or not growing when it should. If you ever see a narrative like vaults are full while deliverable supply is tight, that's your first clue that the issue is willingness and category, not existence. Third, physical premiums and availability. If coins and small bars are suddenly harder to get at normal premiums or delivery-led, times stretch that S not definitive on its own, retail is a small slice and fabrication is its own bottleneck, but it has a valuable street symptom when it lines up with spreads. Fourth, institutional behavior. Watch whether ETFs and other vehicles are seeing inflows or outflows during volatility. Heavy inflows can be a demand shock. Heavy outflows can relieve stress if metal returns to the market, or it can do nothing if the metal is in the wrong places for the benchmark market. And that phrase, wrong places, isn't just colorful. It's the core of modern commodity tightness. If metal is physically in one region while the benchmark delivery demand is in another, you can have both no global shortage and a local squeeze at the same time. That's where arbitrage should fix it, but arbitrage is not instantaneous. Logistics, tariffs, financing, and timing can trap supply. Fifth, cross-market comparisons. Watch silver relative to gold. Watch silver relative to industrial metals. Watch it relative to the dollar and real rates. If silver is moving in a way that doesn't match the usual macro drivers, that often means market structure is dominating, not macro, and that's where the real pressure starts. Notice what we didn't include in the proof stack: the tweet, the leak, the screenshot, the anonymous independent firm. Because even if a real audit existed, audits are rarely the smoking gun people want them to be. A credible vault audit usually looks like process: reconciliation of records, serial number checks, random bar sampling, weight checks, seals, chain of custody controls, sometimes full counts, sometimes statistical sampling, because melting every bar would destroy the product and the logistics. That doesn't mean audits are meaningless. It means audits tell you one thing very well, whether a system is following procedure, and they tell you another thing only indirectly: how easy it would be to satisfy a sudden spike in deliverable demand without reclassification or incentives. So if you see 38% verified, The professional question isn't, are the bars fake? The professional question is 38% of what category, verified how, and what's the conversion friction from non-deliverable to deliverable? Because that conversion friction is where price goes from normal to violent. And the next detail is what flips the whole setup. Owners don to convert eligible to registered out of kindness. They convert because the economics force them to. That's the mechanism nobody wants to say out loud. When the nearby market tightens and the spread pays them enough, or when lease rates, financing, or arbitrage incentives shift, owners reclassify and deliver. If the incentive isn't there, they don't. So the market can sit there full and still be functionally tight. That's not fraud. That's price discovery under constraints. Now let's talk about why this is happening now, not in some vague eventually, because why now is always the dangerous part. It's the calendar. The calendar is the catalyst. People underestimate how often commodities move hardest around windows. Option expiries, futures delivery periods month end, and quarter end balance sheet pressures tax timing, and moments when liquidity naturally thins, like Fridays into weekends, holidays, or just periods where risk managers tell desks to reduce exposure. In those windows, the market becomes less forgiving. Spreads can jump, stops get hunted because liquidity is thin, and a narrative event like a so-called audit leak can become the match, even if it's not the fuel. The fuel is positioning and structure. The match is attention. And this week, that combination matters because when liquidity is thin and the market is jumpy, even a small imbalance forces big price movement. The market doesn't glide, it lurches. Now zoom out one layer. Silver is not just a shiny rock. It's an industrial input and a monetary hedge and a volatility instrument all at once. That's why it whips. Industrial demand doesn't care about your feelings. Procurement managers care about supply assurance, lead times, and budget cycles. They don't buy because a headline went viral. They buy because they need material. And if the market structure suggests future supply might be more expensive or harder to secure, they pull orders forward. That pull forward is subtle, but it matters. Because if enough buyers pull forward, the nearby tightens, the spreads respond, and suddenly the paper market has to price the physical schedule. And that's where the paper versus physical tension shows up first, not in the spot quote, but in the cost of getting it now. At the same time, mining supply doesn't pivot quickly. Silver is often produced as a byproduct of other mining operations. That means you don't just turn up silver production because the price is exciting. Lead times exist, refining capacity exists, fabrication exists, transport exists. All those frictions mean supply is less elastic than people assume in the short term. And whenever demand is even a little sticky while supply is slow, volatility becomes the release valve. But that's not the part that matters. The part that matters is what the institutions do inside that volatility, because institutions don't trade feelings. They trade constraints and risk limits. When price swings become extreme, desks reduce liquidity provision, market makers widen spreads, funds rebalance, and the people who get punished are the ones making emotional decisions in the middle of the whip. Which brings us to the viewer psychology shield, because if you don't protect your brain, you will become someone else's liquidity. Here's how volatility will try to manipulate you over the next 1 to 2 weeks. First, you'll get the pump headline, something like, Vault Silver is fake, audit proves fraud, price to the moon. Your body will feel urgency. You'll want to chase. Then, right after you chase, you'll get the shake. A sudden $3, $5, $7 downdraft that looks like the entire thesis just died. That move is designed to do one thing, make you associate pain with holding and relief with exiting. It trains you. Then, once enough people exit, the market snaps back up on the same structural tightness that caused the first move. And the people who exited feel stupid and chase again. That's how crowds get harvested in volatile markets. The antidote isn't bravado. The antidote is structure. Define your thesis, define your time horizon, define what confirms it, and define what invalidates it before the market starts screaming at you. Because if you wait until the scream, you'll make a decision to stop the discomfort, not to maximize your outcome. And that's where the real pressure starts. So let's turn this into a near-term roadmap that is actually usable. There are 2 scenarios you need to hold in your head at the same time, because that's how you stay sane. Scenario 1 is the controlled pullback and retest. In this scenario, silver backs off from the highs, maybe toward the mid to high 70s, and it tests a prior breakout zone. The key is how it behaves on the retest. Does selling pressure feel heavy and continuous, or does it feel like short bursts that get absorbed? Do spreads stay relatively firm even as the screen price pulls back? Do you see signs that the nearby market still values immediacy? In a healthy bull structure, pullbacks happen, but they are met by willing buyers, and the market doesn't collapse through key zones with conviction. Scenario 2 is continuation, squeeze, and gap risk. In this scenario, instead of a neat pullback, The market stays elevated or rips again, and the danger shifts from can I buy a dip to can I survive a gap? Gaps happen when there's more demand than liquidity at the open, and in silver, that can occur around weekends, thin sessions, and moments when news or positioning collides with fragile market depth. In a squeeze-style continuation, price can overshoot any reasonable target because forced buyers don't care about your valuation model. They care about getting out. Now, you want concrete levels, but we're not going to play fake precision. We're going to use zones. Right now, with silver trading in the high 70s to low 80s, the first zone that matters is the recent pivot region in the mid to high 70s because that S, where the market decided it was willing to pay up after the last bout of selling. If price loses that zone decisively and stays below it, it tells you the market is not absorbing supply the way a squeeze market does. It doesn't automatically kill a longer-term thesis, but it weakens the near-term stress narrative. The next zone is the psychological $80 area, because markets love round numbers the way crowds love slogans. Above that, you're looking at whether the market can hold above prior highs without immediately mean reverting. If it can, the continuation risk rises. If it can't, you get the controlled retest. And here's your invalidation concept, the adult way to do this. The thesis that deliverability stress is driving price weakens if the term structure relaxes meaningfully. If the urgency premium fades, if the market starts rewarding patience again. In other words, if the spread stops screaming, the emergency might be over, at least temporarily. That's the signal, not the headline. Because if this leak is nonsense, the spreads won't care. But if the leak is pointing at a real constraint, registered versus eligible, deliverability friction, supply stuck in the wrong places, then the spreads will keep telling the story even when Twitter gets bored. And that's where the real pressure starts. Now, let's address the counterpoints, because skipping them is how you lose trust. Counterpoint 1, the 38% claim could be pure misinformation. Absolutely possible. Commodities social media is full of people who confuse categories, mix dates, and take screenshots out of context. Counterpoint 2, even if 38% refers to registered deliverable inventory, that number is not automatically bearish or bullish. Registered inventories can be low because owners, want to earn the warehouse economics at current spreads, or because demand for delivery is low, or because the system is functioning normally with most people rolling. So you need confirmation through behavior, not just a ratio. Counterpoint 3, retail shortages don't always mean global shortage. Fabrication can be constrained, distribution can be slow, demand can be spiky, so don't let a coin premium convince you the whole world ran out of silver. It might just mean the bottleneck is in making small products, not in raw supply. Counterpoint 4, macro can slam silver even if the physical story is tight. A dollar spike, a sudden risk off, a rates shock, these can cause liquidation and margin calls that override the physical narrative temporarily. That's why you need scenarios. That's why you need invalidation. And that's why you respect volatility even when you're right. Because you can be right and still get wrecked by timing. That's not pessimism. That's market structure. So here's how you thread the needle. You don't marry the leak, you don't marry the conspiracy, you marry the signals. You watch term structure, you watch deliverability categories when available, you watch physical availability and premiums as a symptom, not a sole cause. You watch institutional flows as confirmation or relief. You watch cross-market behavior to know when macro is steering versus when structure is steering. And you watch the calendar, because the calendar forces behavior. That's the difference between being informed and being entertained. And the next detail is what flips the whole setup into actionable. In volatile, constrained markets, the biggest moves often happen when the crowd believes the danger is past. That's when shorts re-enter. That's when longs relax. That's when liquidity providers tighten. That's when a small shove creates a large move. So if you're going to participate, you do it with humility and a plan. Plan means you know your time horizon. Plan means you have size that can survive a whip. Plan means you accept that the market will try to shake you out, even if the thesis is correct. And plan means you don't confuse a pullback with a reversal unless the structure confirms it. Now, let's go back to the paper versus physical tension one more time because it's the heart of this. Paper exposure can be created instantly. Physical supply cannot. And in a world where trade policies, tariffs, and regional frictions can strand metal in one location while benchmark demand sits in another, the phrase "no global shortage" becomes meaningless to someone trying to source metal in the benchmark hub. Arbitrage should fix it, yes, but arbitrage lives in the real world. It needs financing, it needs shipping, it needs time, it needs certainty on rules. If policy uncertainty or tariff risk makes participants hesitate to move metal back, then the market becomes regionalized and volatility increases because liquidity fragments. That's not a tinfoil story, that's a logistics story. And when logistics becomes the story, spreads become the scoreboard. That's where the real pressure starts. So what should you expect next, specifically over the next week or two? Expect attempts to weaponize your emotions. Expect the market to swing hard on days when nothing happened in the news, because the news is not the driver. Expect the narrative to change after the move, because narratives are usually written as justification, not as cause. Expect the most confident voices to demand certainty, because certainty sells. And expect that if there is any real deliverability stress in the system, it will express through either persistent richness in nearby pricing, sudden spikes around delivery windows, or sharp rallies that happen when liquidity is thin. On the flip side, if this whole thing is just viral noise, the market will tend to normalize. Volatility may cool, spreads may relax, and silver may start trading more like a macro instrument again, responding more cleanly to the dollar and rates rather than showing idiosyncratic squeeze behavior. That's your scoreboard. Now, there's one more practical point that separates pros from headline chasers, and it's simple. In markets like this, being early and being wrong feel identical. The only way to survive that is risk management that respects volatility. If you size like this is a calm market, the market will teach you humility. If you size like this is a stressed market, you give yourself the ability to stay in the game long enough for the signals to resolve. And resolution is coming because the calendar doesn't stop. There will be moments where funds rebalance, where hedgers roll, where dealers adjust, where liquidity thins, and where the market has to decide if it is pricing a real constraint or just a story. And that's where the real pressure starts. So here's the clean takeaway you can carry into the next week without needing to believe anyone leak. 1. Stop treating vault totals like deliverable supply. They're not the same. 2. Remember the hidden detail, registered versus eligible, is a lever, and the lever moves when incentives force it to move. 3. Watch the term structure and nearby behavior, because that's the lie detector when the headline is loud. 4. Hold both scenarios in your head, controlled pullback and retest versus continuation squeeze and gap risk. 5. Define what would weaken this thesis. Relaxation in spreads and urgency, failure to hold key pivot zones, and price behavior that looks like liquidation without immediate absorption. And 6, guard your mind. Volatility will try to train you to buy high and sell low by pairing pain with patience and relief with bad decisions. Don't let it. If you want to be part of the crowd, follow the headline. If you want to be part of the small group that actually survives these markets, follow the mechanism. And if you're the kind of person who cares more about plumbing than propaganda, more about spreads than slogans, and more about what gets delivered than what gets tweeted, then you already know what we're doing here. Stick around, compare notes, and keep your eyes on the scoreboard, not the theater.